Pure Financial Advisors, a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. This is Your Money, Your Wealth on Talk Radio 760 KFMB. Now, here's Joe Anderson and Big Al Clopine.
Welcome, everyone. Show's called Your Money, Your Wealth. Joe Anderson here, Alan Clopine next to me. Thanks for tuning in here for the next couple of hours, talking financial matters, financial planning, taxes, investments, the markets, Social Security, whatever. That's what I got now. Just a whole hodgepodge.
Well, that's like every week.
What do you got?
I got really cool stuff. I've got 6 smart ways to lower your required minimum distributions.
6
required minimum distributions. Yeah, 6. I've got new rules on if you miss your 60-day rollover. Some ways to avoid that penalty.
Yeah, that's hot off the press, but that came out on Wednesday.
Yeah, it came out on Wednesday.
It's almost the end of August. Hopefully, everyone enjoyed their summer.
Yes.
Labor Day weekend is right around is it Labor Day?
Labor Day.
Labor Day weekend.
It's going to be next weekend, actually. But I'm running in a race in La Jolla on Sunday. It's called the End of Summer race from La Jolla to Pacific Beach. That'll be fun. For some reason, you didn't want to do it.
Sounds like a great time Sunday morning.
Get up early.
Yeah.
With 1,000 other people.
Yeah.
And run 4 miles.
Here, well, give me. I want to hear the 6 key ways to reduce your RMDs.
Okay,
so let's explain first of all what an RMD is.
Excellent.
That is called a required minimum distribution. So once you turn 70 and a half, you have to start pulling money out of an IRA. If you are 70 and a half and still working and own less than 5% of the company, you can delay your required minimum distribution until you retire. Then that required distribution is April 1st, the year after you retire. But, what this article is saying, some snazzy ways to reduce the RMD?
Well, yeah, Joe, because a lot of people that have saved in their retirement accounts, they get frustrated at 70 and a half.
Yeah, I saw a study that a lot of individuals that have a certain balances, they don't spend them.
They don't spend them, right? And so they get frustrated because now they have to pay taxes on income they don't even spend.
Right. So if you have a retirement account, every dollar that goes into the retirement, not every dollar, but if it's pre-tax, right, then that dollar goes tax-deferred, and then when you pull it out, then it's taxed at ordinary income rates.
Correct.
And so if you're a first-time listener to the show, we talk about taxes quite a bit. Big Al's a CPA. I'm a certified financial planner. We've been doing the show 10 years. Al's been in the business 30 years. Me, about 18 years. So we know a couple of things.
Sure.
Not all. But a couple.
Yeah, we don't profess to know everything. When it comes to taxes and finance, we know at least half of it.
Yeah, if that. So all right. So let's talk about savvy ways. I'm going to guess. I'm going to throw out a few guesses. I'm going to say one's a Roth conversion. I'm going to say one is spend your money. I'm going to say number 2 is to gift it.
Okay.
So what's that? That's 3.
3.
4. Let me see. What else?
So you got 3 of the 6 already.
All right. See? Boom. See, half. That's half.
That's all
half.
That's our knowledge level.
That's
is
all
half.
we said.
we got big gaps.
Oh, man. How else can I reduce my required distribution? I can die.
That's number 7. That wasn't the recommended thing.
Let's see. What else could I do? So I can do that gift of $100,000 to a qualifying charity.
Yep.
I can do a Roth conversion because a Roth conversion would reduce the RMD because now I paid the tax and put it into a Roth.
Yep.
I can just spend the money. That would reduce it.
Yep.
All right.
Okay. So you got 1, 2, and 5. 1, 2, and 6.
The other 3 are probably just really stupid.
We'll see.
All right.
So number 1 is they title it as manage your withdrawals, which is another way to say spend your money. So once you turn 59 and a half, you can withdraw money from your tax-deferred accounts without paying a 10% penalty.
Sure, and I guess what they're saying is that to fill up the brackets, in a sense, right?
That's right. So you have to pay tax on it, of course, but you don't have to pay that 10% penalty. So you have to pay ordinary income taxes, but maybe you're in a low bracket, you just retired, and you want to fill up those lower brackets, right?
Yeah, because I think a lot of advice is always defer that, right?
Yeah.
You don't want to spend it because it's taxed at ordinary income rates. God forbid you spend that.
Sure. defer.
So spend
Right.
everything else and let that continue to defer and only take it out when you absolutely have to.
Yeah, that is the advice. And what happens, Joe, as you know, is you retire, and in many cases, you're in a lower tax bracket because you're living off of your non-qualified, your non-retirement assets that are tax efficient. You're in very low brackets, and then all of a sudden you hit 70 and a half and you're in very high brackets. And if you could sort of manage that and level that out a little bit and actually fill up those lower brackets, even though you don't have to, you end up paying a lot less taxes over your lifetime. And so, of course, that's one way to do it, is just pull money out of the IRA and put it into your non-qualified account. Or spend it. But that's not the best way. The best way is number 2, which is converting to a Roth IRA. So it has the same tax treatment. Actually, you can do a Roth conversion. You can take money out of your IRA, out of your 401k, and you can put it into a Roth IRA. You pay tax on it in just the same manner as if you took it out and spent it. So it's not like it's not like you put the money in your own savings account. You put it in a Roth account. But the advantage there is all future income growth and principal is 100% tax free.
Yeah, there's no age limitation to this too, and there's no income limitation. So I get this as like, well, no, I can't put money into the Roth because I'm retired. Well, no, you can always convert. If you have money in a retirement account, you can take those dollars out of the retirement account, pay the tax on it, and put it into a Roth. And then you're thinking, well, why on earth would I want to do that? Is that okay? Well, if you're going to keep it in the IRA, it's going to continue to grow, hopefully, for you, right? And so all of that growth is still in the shell of an IRA. When you pull that out, the principal or whatever that you were going to convert is still in the IRA.
Yes.
So that plus the growth is all going to be taxed at ordinary income. If you can do this strategically and start chipping away at this thing and slowly start getting money out of the retirement accounts, moving it into a Roth, yeah, you pay tax on it, but then all future growth in principal, everything is going to come out to you tax-free. And then let's say if you need an emergency opportunity or if you want to control your tax brackets long-term, it's ideal to have dollars in different tax categories to really control the taxes, because then you can pull from different areas and reduce the overall tax bite.
Yeah, and stay out of higher tax brackets. And a lot of people don't realize you can do these Roth conversions even before 59 and a half. You can be any age and do a conversion. You can be in your 20s and do a conversion. Yes, you pay the tax, but there is no 10% penalty when it's a Roth conversion.
Right,
Now,
unless you withhold. So that's a good point, is that because even I'm under 59 and a half, I'm 40 years old, I do a Roth IRA conversion. There is no penalty to do that. People think, no, I have to be 59 and a half. No, that's wrong. The IRS classifies it as a rollover. So a rollover is a tax or a penalty-free event in this scenario. You do have to pay the taxes. However, if you withhold taxes, that's where you get in trouble, right? Because then that withholding is paying the IRS. Well, that withholding to pay the IRS to pay the tax, that's not a qualified distribution. So that would be subject to the 10% penalty.
Right. So you got to be careful that when you're under 59 and a half. But yeah, Roth conversions, and it's not all or nothing. You can convert as much as you want to in any given year. So usually you want to do it over several years to stay out of higher tax brackets. And here's one more quick tip, is if you do a conversion, let's say of $50,000, and you're ready to do your tax return next year, and you realize, oh my goodness, I went into the next bracket by $10,000. You can actually recharacterize next year for this year's conversion as if that $10,000 didn't happen. You take $10,000 out of the Roth, and now you send it back to the IRA. So now it's like you only converted $40,000. So you can fine-tune this into next year up to the filing date of your return, April 15th or October 15th if you extend.
I mean, there's a lot of things that you have to really consider to have a rock-solid retirement game plan. I mean, there's so many different strategies that you can combine to reduce your taxes, maximize the overall wealth to you, your family, to the next generation. It's not about a number. It's not just about your investments. I mean, imagine if you could fill in all the gaps and have all the answers to a rock-solid retirement game plan that covered everything from A to Z. I mean, imagine what kind of confidence that would bring.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the program. Show's called Your Money, Your Wealth. My name is Joe Anderson. I'm a certified financial planner with Big Al Clopine. He's a CPA. Thanks for tuning in. Check us out on iTunes if you like. A lot of podcast listeners out there. iTunes, Your Money, Your Wealth. You can get us any day, anytime. It comes directly to your smart tablet, phone, whatever that you use to listen to podcasts,
yeah.
So a couple of different events that we're doing. Go to purefinancial.com to get more information here, but we're doing a webinar coming up here in the next week or two on long-term care. Not necessarily long-term care insurance, but just all the different things that you have to consider in regards to that. then we dive in. We're doing some every last Wednesday of the month. We're starting that next month. We're doing just a quick lunch and learn. 45 minutes, give you a sandwich, come into the office. We just break it down to 20 people. And so we go through kind of a retirement income scenario. It's kind of an introduction to financial planning. So if you want more information, you can go to our website on that as well. So purefinancial.com. We're talking about ways to reduce your required minimum distribution. And Big Al has 6 key things here. And we've gone through what, 2 of them?
Got through 2. And so at 70 and a half, you have to start taking money out of your IRA, 401k, even if you don't want to. And a lot of people, where they've saved a lot of money into these IRAs, 401ks, they don't necessarily need all that income, but all of a sudden they get jumped into a higher tax bracket. So the first way was when you retire and before 70 and a half, you start withdrawing money out of your IRA just to fill up lower brackets. Maybe you put it in your savings account, maybe you spend it. Or a better way is actually to convert those same dollars into a Roth IRA so that all future growth and income is tax-free. Here's the third one, Joe. We don't really talk about this much, but this is a valid way to reduce your RMD, is invest in a QLAC.
Oh, whatever.
A qualified longevity annuity contract.
Sure.
So here's what it is that you can invest in this qualified longevity annuity. And for example, it would be like a 65-year-old man who puts $100,000, and this is a policy, I guess, and we don't sell insurance, so we're not promoting insurance at all, but this is New York Life. I guess at the time of this article, which just came out from Kiplinger in August, they said invest $100,000, age 65, at age 85, which is the latest that you can actually start receiving a payment stream. This individual would receive $22,331 of guaranteed income
for the rest of your
life. So here's the idea. The idea is it's if you live a long life, this $100,000 helps you bridge the gap from from living into your 90s or even hundreds, which a lot of people are doing right now. So unfortunately, let's say you die at 83, you lost the $100,000. It's just like any insurance product in a sense. Like home insurance, you pay that policy every single year, and if your home doesn't burn down, well, it's lost money. But if your home does burn down, you're glad you have it.
I think there's different types of hybrid products and things like that. We should probably get a little brushed up on the old QLAC.
QLAC. Well, here's a couple more things that we do know within our 50% of knowledge that we actually do know.
See, I told you.
Yeah, which is you can invest in your IRA up to 25% of your IRA or 401k or $125,000, whichever is less. So if you got millions in your IRA, this probably isn't going to help you too much. But maybe you have a couple $100,000 or $400,000, and you've got longevity in the family. So once you invest it in this qualified longevity annuity contract, that piece is not subject to the required minimum distribution. So you could effectively defer it from 70 and a half to age 85 if you want to.
Got it.
So anyway, that's one. Here's number 4.
Okay.
And we talk about this, although I don't think we've said it this way, rejigger investments.
Okay. Which is asset location?
Yes. Another way to lower your RMDs is to use tax-deferred accounts for bonds and bond funds and use taxable accounts for stocks and stock funds because the bonds are going to grow less. You don't necessarily want your highest growth assets in your IRA. It just increases your future required distribution.
So here's a quick example of what asset location means, because I think people hear that and then they blow themselves up. Because most of you probably have the bulk of your wealth inside the retirement accounts. And that's very common. I mean, we see millions are now in these 401ks, IRAs, and defined benefit plans and everything else. And there's, we still have many, many clients that have millions outside, but it's more common to see the bulk of the liquid assets. So, you might have a real estate portfolio, then you have a retirement account, you got some cash reserves, and you got, a couple of cars.
Sure.
That's usually what we see. But let's say you do have some money outside of your retirement account. Let's say you got $1 million inside your 401k and you got $100,000 in a brokerage account. So that's $1.1 million.
Okay.
And then someone will hear this and say, okay, well, you want to keep your bonds in your retirement account, your stocks in your brokerage account. And so then the brokerage account will be in stocks, and then they got everything in the retirement account in bonds.
So they got $1 million in bonds.
Yeah, you don't want to do that either, right? So you take a look at what is the mix. So let's say you want a 50-50 split, right? So 50% stocks, 50% bonds. Well, then you're like, well, here, I don't have 50% outside. Well, yeah, I know. So you fill up your brokerage account with stocks, And then you go to the retirement account, fill that up with stocks, and then you put the rest of the 50 into bonds.
Yeah, I'm glad you explained that, Joe, because I think a lot of people do sort of take stuff out of context and then take it as gospel. And really, if you had
You look at your allocation first. So you want a 60-40 split, 70-30 split, 50-50, whatever that is, and then do some math to figure out how you fill your overall qualified, non-qualified Roth buckets.
And to make it even a little bit more complicated, if you got $100,000 outside of retirement, maybe you want to have $50,000 in a cash reserve.
Or I'm just saying that was earmarked for retirement.
But I just want to be clear on that too. So then maybe you got $50,000 in cash, $50,000 in stocks in your non-retirement account, and then you do the rest between stocks and bonds for your 50-50 allocation or whatever allocation that you want to do, whatever makes sense for you.
Right. And you take a look at because how it works is you want to dampen the growth in the retirement account. But what we see often is that maybe you might have several $100,000 outside. Maybe you sold a business. Maybe you sold some property. You inherit some money. And then we see most of that in cash. And then maybe $100,000 is fine in cash, but you have $300,000 in cash. Well, you're looking at retiring. Hey, I want to keep this fairly safe because I'm going to start drawing down from it. Well, no, then you have to take a look at a distribution strategy. You don't want to blow through all your non-retirement assets first and let your retirement assets grow. So some of that should be invested and earmarked long-term for retirement, and then you can start taking a little bit from the retirement account and a little bit from the brokerage account. Then you have to look at taxes.
Sure.
But most people will say, no, I'm going to keep this in cash, spend that down, and then touch the retirement accounts, and they're missing a huge, huge opportunity from a tax-efficient retirement income strategy.
Yeah, that is the advice that a lot of people are getting. And the reason why that's not very good advice is because if you think about it, if you invest in stocks outside of your retirement accounts and you hold a stock or stock mutual fund or whatever for at least a year and you sell it, it's subject to a special long-term capital gain rate. You ever hear the thing about Warren Buffett paying lower taxes than his secretary? Well, that's because he is investing. And when you invest, the government says we're going to give you a special tax rate because we want you to invest. We want you to hold your investments for a year. So that tax rate, the capital gains rate is in some cases 0%, in some cases 15%, in other cases 20% for those that make the most money. Now, the ordinary income tax rate starts at 10%. It goes to 39.6%. So it's a lot higher rate, Joe.
Right. And so I think what people have to take a look at is forward-looking when it comes to an overall tax strategy instead of, all right, well, here, this is what I'm going to draw today. If you take a look forward and say, this is where my taxable income is going to be, here's my distribution strategy. And you have to take a look at it every single year.
Isn't that true, Joe? Because I think most people, what we see is they look at 1 year at a time. And when you look at a whole bunch of years, like all your years of retirement all at one time, you probably will make pretty big changes in your strategy. And the whole reason is because you do have some control over your taxes as long as you know what the strategies are and what's available to you. But most people don't realize it. Most people don't realize they have much control, but in retirement is when you have the most control over your taxes because you set up your own distribution plan. You draw your assets from wherever you want to within certain limitations like a required distribution. But what we have found is a lot of advisors out there are not giving you the right advice. They're not teaching you how to maximize your tax brackets, particularly when you first retire in your lower tax brackets, and it's because a lot of advisors don't focus on forward-looking tax-efficient strategies.
Now back to Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the show. You're listening to Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner. I'm with Big Al Clopine. He's a CPA. Thanks for tuning in. Check us out online. Our firm is called Pure Financial Advisors. PureFinancial.com is the website. A lot of different events coming up from now until the end of the year. Doing some webinar series once a month. We did one on Medicare last month. We're doing one on long-term care. We did one on identity theft. We did a tax one. So all sorts of different things. More education. Go to Pure Financial. Just click on the Learning Center, I believe. And you'll find a bunch of different information there, too. We got hundreds of videos as well.
We do. And if you did miss any of those old webinars, they're right on the website.
Yes. So we send out an invite, right?
Yes.
And so we do the webinar during the day.
Mm-hmm.
10 o'clock, 10 to 11 or something like that.
Yeah, that's a normal time.
Right.
Yeah.
And so you can log in, and then we say on the invite,
yeah,
hey, register. All you got to do is register for the webinar, and then you will be sent a link to the replay. And then you know how many emails? Hey, I work for a living.
Joe, this is not a good time. Have you ever thought of doing it on Saturdays?
Yeah, how about Friday night? That'll work. I'm like, well, did you read the invitation? The invitation said all you got to do is register, and you can watch it at your leisure. So if you want to watch it Sunday morning at 4 a.m.,
yes,
you got it.
You know why, though? Because we're on information overload. You get emails, you get hundreds of emails every day, and you just don't have time to read them. So there you go.
Is that okay?
I'm just telling you reality.
We're getting into some required minimum distributions. Thought this article was going to take 5 minutes, but now we're in segment 3.
Yeah, we're still rolling. Six ways to reduce your required minimum distribution, and we did the first 4, and I got 2 more, Joe.
All right.
And so one of them, you know this one, keep working. It's 70 and a half, your 401k. As long as you're not the owner, as long as you don't own more than 5% of the company, guess what? That company 401k, and you're working, you don't have to take a required minimum distribution. And if you got some old 401ks, maybe you can even roll them into your new company 401k, and then you don't have to take a required distribution from them either.
Right. You have to be an active participant in the plan, and no more, you can't be a 5% owner. And you know what? This whole 5% owner, it's complicated. Right?
Yes.
So let's say this. Here's kind of a couple different side notes with this.
Okay.
That I've ran into, where let's say I'm a 5% owner. I'm 70 and a half. Okay. Maybe I'm a 10% owner. Whatever. Okay. And then I'm 70 and a half. That means, oops, I'm in the 401k plan. I'm taking my distribution. But wait a minute. Now I'm, getting older. Right. Maybe I want to slow things down. So I'm going to start selling my shares. Right, given some of the company, selling it to other employees of the firm or whatever. So now I'm down to a 2% in owner of the company, and I'm 73. Right, I'm still working. I still got money in the plan. I'm still active participant. I'm putting money into the plan. Do I have to take a required distribution? What do you think?
I wasn't listening. You answered.
Come on.
I wasn't even listening.
You were looking at me smiling now.
I'm just
I'm
trying to encourage you.
The answer is it doesn't matter. As long as you're a 5% owner of the company and you gave all your shares away the next year, you still have to take a required distribution because you once were.
Okay, well, I heard the answer.
How about this, Al?
Okay, I'll listen this time.
Let's say you have family members, right? You have a family business.
Yes.
And you have a 401k plan.
Okay.
Right? And you're a 100% owner, but then you give all of your shares to your son.
Okay. 100%.
You're 70, so you have no more ownership of that firm. Your son does. Do you have to take a required distribution?
Well, that sounds like the other one, so I'd say yes.
No, let's say you're 65 years old. You give it to your son. Your son's...
Oh, you're 65.
Right, and now you're 70 and a half. You don't own any of the company.
Yeah, so, well, maybe not.
Yes, you do. Because they look at...
what it was at one point, huh?
No, they look at kids. They look at spouses. They look at whatever. So if you're working, your spouse owns 10% or 5%, and you're working, it's still... So it kind of goes down the family tree as well.
You are. All right, very good.
So are you listening now? So
yeah.
This is some good information that you need to learn.
Because
you're going to run into a scenario, I guarantee you, next week. And then you'll be like, you know what? Anderson was talking about this on the radio.
What was
I'm
he
sitting
saying?
right next to him.
I wish I was listening. And I know our listeners do that.
Yes.
They tune out selectively because it's not very interesting sometimes.
I thought it was very interesting. I thought I was just giving you some nuggets here.
Anyway, I'm with you now.
All right.
That's good stuff.
Okay.
Right?
I'm tuning out now. You go whatever you got to go with.
The last one, don't listen. Well, you already guessed this one. Donate your required minimum distribution.
What's that called again?
It's called a direct IRA contribution or RMD to charity, I guess.
I don't know. This show is awful.
So here's the concept. I don't know what it's called.
I thought it was like, I thought it had an acronym of some sort.
Probably.
All right.
It's not in.
Are you a CPA?
It's not in this article. Do you know how many acronyms I have to memorize? I don't know them all. So when you hit 70 and a half, you have to start taking a required minimum distribution. So here's what the IRS, and this is something, it's kind of weird. They came up with this rule about 7-8 years ago, and they just did it 1 year at a time. And then every single year they put through a bill to decide whether they want to extend this rule again for yet another year. And they kept doing it and kept doing it. One year they actually didn't even extend it until the year was over.
Right.
So try to figure that. But anyway, so now it's a permanent rule. So you're at age 70 and a half. You can give up to $100,000 from your IRAs directly to charity each and every year. And if you're married, it's $100,000 each. So that can be in lieu of your required minimum distribution. There's no problem with that. And so some people that have lots and lots of money in their IRAs and they're charitable, then they can go ahead and do that. That's a permanent rule. And like I say, each and every year. And sometimes, even if you just do a little bit that way, what happens is you take your required minimum distribution off of your what's called adjusted gross income, page 1 of your Form 1040, which then may reduce how much of your Social Security income is taxable. So there's some real benefits for some taxpayers in doing this. In other cases, by getting that required minimum distribution off the adjusted gross income, page 1, then they keep out of having to pay that Medicare surtax on interest and dividends and capital gains. So if you're actually this applies to lower income earners as well as higher, this can be a great strategy, assuming and presuming that you've got some extra capital that you don't need yourself.
Right. So yeah, if you don't need to spend it, that's probably the best way to give to charity, because right, you're taking money that's in a shell that's tax deferred, that's going to be taxed at ordinary income, to get that out of your estate and give that to the charity versus cash or selling an asset and then giving it to the charity. So there's different strategies there. I'm saying instead of selling it, you could just give that appreciated asset to the charity. So I mean, retiring today, it's successfully, I guess, it doesn't happen by accident. It's more than just saving and investing for retirement. It happens with the plan. It happens with the plan for how and when you'll claim your Social Security benefits, for instance. It happens with the plan for when you will draw your money from your IRAs or 401ks and other retirement accounts. It happens with the plan to pay fewer taxes. And it happens with the plan to turn your savings and investments into income while reducing your risk. Do you have that plan?
Now back to Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the program. Show's called Your Money, Your Wealth. Joe Anderson here, certified financial planner, Big Al Clopine. He's a CPA. Thanks for tuning in. Go to purefinancial.com. Learn a little bit more about us, our firm. We're a fee-only registered investment advisor, fiduciary 100% of the time. There's never a product sold at our firm. What we do is give advice. So if you want more information about us, go to purefinancial.com. What else do you got? It looks like you got a whole bunch of highlighting there on that article. That
I did.
Spent some time on that one, huh?
I
you got
did.
some side notes?
Yeah, I mean, these are just kind of interesting. You've talked about this, centurions.
Yes.
Those that are over 100.
Yeah.
So as of 2014, there were 72,000.
72,000.
Americans.
Now there's probably about 200,000.
Well, I don't know right now, but what's being estimated by 2050 is a million. And by the way, this 72,000 is 44% higher than in the year 2000. And so here's the quandary, is that in a lot of cases we are planning for a retirement of maybe 20 years, 65 to 85, but a lot of us are living into our 90s, right? And even 100. And they actually, this is Investment News, did a survey of 348 advisors to find out, well, you're doing financial planning. To what age are you doing the financial planning to? And it was kind of interesting. What they found out was that advisors use an average lifespan of 91 years for men and 94 for women.
Huh. We use 95.
We use 95 for both. Sometimes 100. Some of our clients feel like they've got longer life expectancy, and we can, of course, run it to anything that you want. But what's interesting is that's, if you think about it, those are reasonable numbers, because for a 65-year-old, the average life expectancy for male is about 84, almost 85, and for a woman it's 87, almost 88, according to the CDC, which is the Center for Disease Control. Forget it.
Oh my God.
Centers for Disease Control and Prevention. That's what that is. I thought it was so tight on this too.
You got it highlighted.
I know.
There's like side notes.
What
Oh,
the
man.
heck is that? So we're
living longer.
But here's the thing, Joe, is that's the average, right?
Right. So
80. But what happens if you're above average? I mean, so half are below for men, 84, and half are above. But so a lot of men and certainly women are living into their 90s and 100s. And if you haven't really thought this through, then it sort of messes up your whole retirement plan.
Right. For sure.
Right.
And I mean, I think more and more of us know individuals that are in their late 80s, 90s. And then there's a lot of you that know people that are, age 100.
Yeah, exactly.
It's a lot more common, and it's going to be more common.
Yeah, what's interesting, Joe, is when you sort of track life expectancy. If you go,
because that's what I do on the weekends.
You track it.
Yes, I do.
So in
right when I'm going to leave this show, I go back to my little. I got charts everywhere. This little chart room.
You got the chart room.
I have a
upstairs,
chart
yeah?
room.
Nice,
Yes,
okay.
it's on the age wave and life expectancies.
I took a picture of your chart room, and in 1900, the average life expectancy for a newborn is 47 years.
47 years.
Mm-hmm.
All right.
And 2016, it's 79.
79 for newborn.
For newborn. Now,
Right.
realize when you're by age 65, you've already passed through, a whole lot of
yeah,
time.
right.
So your odds now are to make it to between 84 and maybe 88, depending upon your male or female.
And then once I hit 70, then I can get down to, close to 90 or something?
Yeah, when you, I think when you hit 75.
I got to go to my chart room for
Yeah,
that.
men can expect to live on average to 86 and women 88. But here's what they're thinking by 2050. The average for a newborn will live to about 84, and women 86, and men 81. That's a newborn. So that means if you're 65, you're probably looking into your 90s.
Yeah.
So I'm going to be doing this show until I'm 100 years old.
I can't. Oh
Pretty
my
sure.
God. Dude, you're going to go through like 6 co-hosts.
So interestingly enough, at least I found this interesting, is there tend to be growth spurts in life expectancies based upon certain things that happen. So like in the early 1900s, 20th century, the life expectancy grew because of improvements in infrastructure, like sewer systems and decline in communicable diseases. So that's pretty cool. And the second half of the century, life expectancies grew because of education, money, antibiotics, improvements in surgical interventions, better prevention. So who knows what the next spurt will be?
Yeah.
Early detection from other cancer, other diseases. So yeah, you don't know. But then the most important thing, Joe, is so if we're living longer, how do we adjust our retirement plans to be able to accommodate that? And I think the first thing that you got to do is
work longer.
Yes, exactly. And if you work longer, let's think about that. Because if you retire at age 66, which is
But the average age right now is still 62.
I know. But even if you retire at 66, waiting till 70 is a big difference. But you're right. The average age, at least the last report that I saw for women was 62 and men was a little bit closer to 64. But still, if you retire at 62 and take your Social Security then, versus waiting till age 70, which is the last date that you can take Social Security, it's a 76% increase from 62 to age 70. So in other words, instead of receiving $1,000 per month, you're receiving about $1,720 or whatever your number is, multiply it by 1.72, and that's how much more that you would receive just from Social Security. Then let's also think about, all right, so you worked another 8 years, you hopefully saved into your 401k or your 403b or whatever savings vehicle you have, another 8 years of savings and growth. And by the way, you were not withdrawing those funds for retirement. So you're in such a stronger position if you work longer. And sometimes, Joe, it's even working a year or two longer makes a huge difference.
Right. It's just, just tweaking a couple of different things. Yeah. I think still, we have a lot of clients that retired early, and a lot of them are like, man, I think I might have retired a little bit too early.
Right.
It's like, well, now I'm looking, I'm getting the itch, to do something here.
Yeah.
I had, a good couple of years. I got the honeydews done. I did a little bit of traveling. I did this and that, and now it's like, okay, got to find something to do.
Something to do. And Joe, you know as well as I do, a lot of people expect that they're going to be working longer because they need to or they want to. But we do find out from a recent study that about 50% of retirees leave the workforce earlier than they had planned. And that's usually because of poor health or layoffs
Right.
or being a care provider for a spouse or parent or something like that. Very, very common. So because of that, I think a lot of financial advisors, I mean, the old rule used to be save 10% of your income. A lot of advisors are now saying 15%, which is what we say too. I think that's a better number. It's a better goal. And of course, the sooner you do it, the better. If you start saving 15% in your 20s, you're probably in pretty good shape. If you haven't saved anything and you're 58, you probably need to save more than 15% to make this work,
Right.
and cut spending and so forth. And I would say probably the other thing that doesn't get a lot of press, Joe, is taxes. Because when you think about it, a lot of folks have saved the majority of their assets in their retirement accounts. And when they pull those assets out, it's taxed at their ordinary income rates.
Right. They need, I mean, most people need every strategy they can possibly think of to stretch out their dollar another year, another 2 years, 3 years, 4 years, or something like that. I had a webinar meeting with Bob Keebler, who's been on this show, and just looking at some, tax efficiencies on the withdrawal strategies of how much longer that the money will go. I mean, if you're smart about this, and that's what we've been trying to teach you for the last 10 years, of being more tax savvy when it comes to your retirement income.
Yeah, because when you think about it, taxes don't stop when your paycheck does. And when you start tapping your retirement nest egg, there's all sorts of rules. There's opportunities, too, if you know what to do and how to do it. Because instead of contributing to a tax-deferred plan to reduce your taxes, you'll start tapping those accounts. You start pulling money out. You start paying taxes at ordinary income rates, unless you're taking money out of a Roth IRA. As you near retirement, tax planning becomes more important than ever, but you must use a forward-thinking tax strategy because truly you've got more control over paying taxes in retirement, more than you think, actually more so than any other time in your life.